Welcome back to the channel. Today, we're diving into the 5 fundamental rules that separate successful stock investors from those who lose money in the market. These aren't get-rich-quick schemes or hot tips, these are time-tested principles used by legendary investors like Warren Buffett, Peter Lynch, and Benjamin Graham. Whether you're investing in your first stock or managing a substantial portfolio, these 5 rules will help you build wealth systematically while managing risk. I've been investing for over a decade, and I can tell you, following these principles has made all the difference between my early losing trades and my current consistent gains. By the end of this video, you'll understand exactly how to research companies, manage risk, control your emotions, think long-term, and maintain discipline in your investing journey. So let's get started with rule number 1. The first and most critical rule: never invest in a company you don't understand. This sounds obvious, but you'd be shocked how many people buy stocks based on a hot tip from a friend, a Twitter post, or a trending ticker symbol, without having any idea what the company actually does. Warren Buffett has a famous rule: only invest within your circle of competence. If you don't understand how a biotechnology company develops drugs, don't invest in biotech. If artificial intelligence seems like magic to you, maybe avoid AI startups until you educate yourself. So how do you do proper research? Start with the company's fundamentals. Look at their revenue growth over the past 5 years. Is it consistent? Are they growing faster than competitors? Check their profit margins. A company might have high revenue but tiny profits, which is a red flag. Next, examine their balance sheet. How much debt does the company carry? A healthy company should have manageable debt levels relative to their assets and cash flow. Too much debt can sink a company during economic downturns. Read the company's annual report. Yes, actually read it. The 10-K filing contains everything you need to know: their business model, risks they face, competitive advantages, and management strategy. The management discussion and analysis section is particularly valuable. Understand the company's competitive advantage or moat. What prevents competitors from stealing their customers? Is it brand power like Apple? Network effects like Facebook? Patents like pharmaceutical companies? Low-cost production like Walmart? Companies with strong moats can maintain profitability for decades. Also research the industry trends. Is this sector growing or declining? Investing in the best horse and buggy company in 1920 would still have been a terrible investment because the automobile was making that entire industry obsolete. Make sure you're in growing industries with favorable long-term trends. Finally, understand the valuation. A great company can be a terrible investment if you overpay. Look at metrics like PE ratio, price to sales, and compare them to industry averages and the company's historical ranges. Just because a stock price is going up doesn't mean it's a good value. Peter Lynch said, "Know what you own, and know why you own it." That's rule number 1 in a nutshell. Rule number 2, diversification. This is your safety net, your insurance policy against catastrophic losses. Here's a harsh truth: even after thorough research, you'll be wrong sometimes. Companies you're confident about will disappoint. Industries you thought were stable will get disrupted. Management teams will make terrible decisions. Economic events will blindside everyone. This is why you absolutely must diversify. The math is simple but powerful. If you put all your money into one stock and it drops 50%, you've lost half your wealth. But if you own 10 stocks and one drops 50%, you've only lost 5% of your portfolio. Diversification reduces the impact of any single investment going wrong. But diversification isn't just about owning lots of stocks, it's about owning the right mix. You need diversification across multiple dimensions. First, diversify across sectors. Don't just own tech stocks. Include healthcare, consumer goods, financials, energy, industrials, and real estate. Different sectors perform well at different times in the economic cycle. When tech crashes, consumer staples might hold steady. When energy slumps, technology might soar. Second, diversify by company size. Own large-cap blue chips like Microsoft and Johnson & Johnson for stability. Add some mid-cap companies for moderate growth. Maybe include some small caps for higher growth potential, though these carry more risk. Third, consider geographic diversification. The US stock market is excellent, but it's not the only game in town. International stocks provide exposure to different economies and can reduce overall portfolio volatility. You might own some European blue chips or emerging market funds. Fourth, think about diversification across investment styles. Mix growth stocks with value stocks. Growth companies reinvest profits to expand rapidly, while value stocks might be mature companies paying steady dividends. These perform differently in various market conditions. Now, how many stocks should you own? There's debate about this. Some experts say 15 to 20 individual stocks provide adequate diversification. Others recommend 30 to 40. Warren Buffett actually advocates for concentrated portfolios of your best ideas, but he's Warren Buffett, he has expertise most of us don't possess. For most individual investors, I recommend 15 to 25 individual stocks across different sectors, or simply investing in low-cost index funds that automatically provide broad diversification. The S&P 500 Index Fund gives you ownership of 500 large American companies in one investment. Here's what diversification does not mean. It doesn't mean randomly buying stocks in different companies without research. Owning 10 poorly researched stocks isn't diversification, it's just owning 10 bad investments. Each position should still meet your investment criteria from rule number 1. Also, avoid false diversification. If you own 5 different smartphone manufacturers, you're not really diversified, you're just concentrated in one industry with multiple positions. True diversification means when one holding struggles, others might thrive. The legendary investor Harry Markowitz won a Nobel Prize for portfolio theory, which mathematically proves that diversification is the only free lunch in investing. You reduce risk without necessarily reducing returns. That's powerful. Remember, diversification protects you from what you don't know. It's humility in action, acknowledging that despite your research, the market can surprise you. Rule number 3 might be the hardest: controlling your emotions. The stock market is a psychological battlefield, and most investors are their own worst enemy. Here's what typically happens to emotional investors: they buy stocks when everyone's excited and prices are high. They panic and sell when markets crash and prices are low. They chase hot stocks that have already skyrocketed. They abandon good companies after short-term price drops. This is exactly backwards, but it's human nature. The 2 most dangerous emotions in investing are fear and greed. Let's start with greed. When markets are soaring, greed takes over. You see neighbors getting rich on meme stocks. Your coworker won't stop talking about their crypto gains. FOMO, fear of missing out, becomes overwhelming. You abandon your disciplined strategy and chase whatever's hot, often buying right before the bubble pops. The dot-com bubble of the late 1990s is a perfect example. Companies with no profits, sometimes no revenue, were valued at billions because they had .com in their name. Rational investors who warned about valuations were mocked as out of touch. Then the bubble burst in 2000, wiping out trillions in wealth. The same pattern repeated with the 2021 meme stock mania. Warren Buffett has a great quote: "Be fearful when others are greedy, and greedy when others are fearful." When everyone's buying and markets are expensive, that's when you should be cautious. When everyone's panicking and selling, that's often the best time to buy quality companies at discount prices. Now let's talk about fear. Market crashes are terrifying. Watching your portfolio drop 20%, 30%, even 50% is psychologically brutal. Your brain screams at you to sell everything and preserve what's left. This is your survival instinct. It evolved to protect you from physical dangers, but it sabotages your investing. The 2008 financial crisis was a masterclass in fear. The S&P 500 dropped 57% from peak to trough. Banks were failing. Unemployment soared. The media proclaimed the end of capitalism. Investors who sold in panic locked in permanent losses. But those who held on, or better yet, bought during the panic, saw their investments eventually recover and reach new highs. The COVID crash of March 2020 is another example. The market dropped 34% in just 23 trading days, the fastest bear market in history. People were terrified, predicting years of depression. But the market bottomed on March 23 and then roared back, reaching new all-time highs by August. Emotional sellers missed one of the greatest rallies in history. So how do you control these emotions? First, have a plan and stick to it. Before you invest, decide your criteria for buying and selling. Write it down. When emotions run high, refer back to your plan. If a stock still meets your criteria, hold it regardless of price fluctuations. Second, stop checking your portfolio constantly. Studies show that investors who check their portfolios daily make worse decisions than those who check monthly or quarterly. Short-term volatility is meaningless noise. Daily price movements are random. What matters is long-term value creation. Third, automate your investing. Set up automatic monthly investments regardless of market conditions. This dollar cost averaging removes emotion from the equation. You buy more shares when prices are low, fewer when prices are high, averaging out your cost over time. Fourth, remember that volatility is the price of admission for superior returns. If you want stock market returns, you must accept stock market volatility. You can't have one without the other. The investor who stays calm during 20% drops will be rewarded with long-term gains. Fifth, focus on business fundamentals, not stock prices. Ask yourself, has the company's business actually changed, or just the stock price? If the business is still strong, temporary price drops are buying opportunities, not reasons to panic. Professional traders have a saying, plan the trade, trade the plan. Your investment decisions should be made rationally when markets are calm, not emotionally when markets are chaotic. Benjamin Graham, the father of value investing, said the market is a voting machine in the short term but a weighing machine in the long term. Ignore the short-term votes driven by emotion. Trust the long-term weighing of actual business value. One final thought on psychology: avoid confirmation bias. This is our tendency to seek information that confirms what we already believe and ignore contradictory evidence. If you own a stock, you'll naturally want to read bullish articles and dismiss bearish ones. Fight this. Actively seek out opposing viewpoints. Challenge your thesis. The moment you fall in love with a stock, you've stopped thinking rationally. Rule number 4, think long-term. This might be the most profitable rule if you can master it. The stock market rewards patience. Let me say that again, the stock market rewards patience. Yet most people approach investing with a day trader mentality, obsessing over weekly or monthly returns. This is a recipe for mediocre results and high stress. Here are the facts: since 1928, the S&P 500 has returned an average of about 10% annually. But here's the catch, that's only if you stay invested. The returns come from long-term compounding, not from jumping in and out trying to time market movements. Studies show that missing just the 10 best days in the market over a 20-year period reduces your returns by more than half. The problem? Those best days often come immediately after the worst days. If you sell in panic during a crash, you'll likely miss the recovery rally. Let me give you a powerful example of long-term thinking. If you invested $10,000 in the S&P 500 in 1980 and just left it alone, you'd have over $1 million today. That's not from getting lucky with stock picks or timing the market perfectly, that's just from staying invested in a broad index and letting compound growth work its magic. Compound growth is Albert Einstein's eighth wonder of the world. When you reinvest dividends and let gains accumulate, your money doesn't just grow, it grows exponentially. The gains from year 1 generate their own gains in year 2, which generate more gains in year 3, snowballing over time. Here's why most people fail to achieve this: they lack patience. They buy a stock, it goes up 20% in 6 months, and they sell to take profits. Meanwhile, that stock continues to triple over the next 5 years. They made 20% when they could have made 200%. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, achieving an incredible 29% annual return. But here's the shocking part: the average investor in his fund actually lost money. How is that possible? Because they bought after periods of strong performance and sold after downturns, constantly timing their entry and exit poorly. They couldn't just buy and hold. Think about the greatest companies of our era. If you bought Amazon in 2001 and held until today, you've made over 100,000% returns. Apple from 2003 to today? Over 50,000%. Microsoft, Google, Netflix, all have been massive long-term winners. But all of them also had periods where they dropped 30%, 40%, even 50%. Emotional short-term investors sold during those drops. Patient long-term investors got rich. Now, I need to clarify something important: thinking long-term doesn't mean buy and forget. It means buy and monitor. You should review your holdings at least quarterly to ensure the business fundamentals remain strong. If a company's competitive position deteriorates, management makes poor decisions, or industry dynamics change permanently, you should sell, even at a loss. But these are business-based decisions, not reactions to price movements. Let me give you the framework I use. I invest with a minimum 5-year time horizon. When I buy a stock, I ask myself, would I be happy owning this company if the stock market closed for 5 years? If the answer is no, I don't buy it. This mindset filters out speculative plays and keeps me focused on quality businesses. Tax efficiency is another huge advantage of long-term investing. In the US, if you hold a stock for over 1 year, You pay long-term capital gains tax, which maxes out at 20%. If you sell within a year, you pay short-term capital gains, which is taxed as ordinary income up to 37%. That's a massive difference. Frequent trading can eat up nearly half your profits in taxes. Then there are transaction costs. Every time you buy or sell, you pay commissions or spreads. Active traders can lose 1 to 2% of their portfolio annually just to trading costs. Buy and hold investors avoid this wealth erosion. But here's the deepest benefit of long-term thinking: it reduces stress and improves your quality of life. When you're not constantly watching stock tickers, reading every headline, or obsessing over portfolio fluctuations, you have mental space for what actually matters: your family, your career, your health, your hobbies. Charlie Munger, Warren Buffett's partner, said, "The big money is not in the buying and selling, but in the waiting." That's profound wisdom. Your job as an investor isn't to be constantly active, it's to find great companies at fair prices and then get out of the way. There's a famous Vanguard study that analyzed investor behavior. They found that investors who forgot they had accounts, literally forgot about their investments, had better returns than active investors who regularly managed their portfolios. Why? Because they couldn't panic sell during downturns or chase performance. Here's my challenge to you: when you buy your next stock, commit to holding it for at least 2 years unless something fundamentally breaks in the business. Not the stock price, the actual business. This single discipline will dramatically improve your returns. And remember, in investing, doing nothing is often doing something very right. Rule number 5, have a clear investment strategy and stick to it with discipline. This ties together everything we've discussed. Without a strategy, you're not investing, you're gambling. A strategy is your framework for making decisions. It defines what you buy, when you sell, how much to allocate, and how to respond to different market conditions. There are many valid investment strategies. You could be a value investor, buying underpriced companies with strong fundamentals. You could be a growth investor, focusing on companies with high revenue growth even if they're expensive. You could be a dividend investor, building a portfolio of stable companies that pay regular income. You could be an index investor, simply buying the whole market through ETFs. None of these strategies is inherently better than the others. What matters is choosing one that matches your personality, time commitment, and financial goals, and then sticking with it. Here's where most investors fail: they have no strategy, or they constantly switch strategies. They're value investors when value is hot, then switch to growth when growth is hot, then try day trading when they see someone boasting about quick profits. This strategy whiplash guarantees mediocre results. Warren Buffett has used essentially the same strategy for 60 years. Buy wonderful businesses at fair prices and hold them forever. It's simple, but the discipline to stick with it through changing market fashions has made him one of the richest people on earth. Your strategy should include clear buy criteria. For me, I buy when the company has a sustainable competitive advantage, revenue has grown at least 10% annually for 5 years, profit margins are above industry average, debt is manageable, and the PE ratio is below 25. Your criteria might be different, but you need to define them. Your strategy should also include sell criteria. I sell when the original investment thesis is proven wrong, a better opportunity emerges, the stock becomes more than 10% of my portfolio, or I need the money for planned expenses. Notice that the price dropped is not on my list. Price fluctuations alone are not reasons to sell. Position sizing is another crucial element of strategy. How much should you invest in each stock? I use a core satellite approach, 50% in low-cost index funds core, 30% in 8 to 10 high-conviction individual stocks satellite, and 20% in cash for opportunities. This balances diversification with concentrated bets on my best ideas. Your strategy should also dictate how you respond to market crashes. Do you have a plan for a 30% market decline? You should. My plan: I stop reading news, review my holdings to ensure businesses remain sound, and deploy cash reserves to buy quality companies at discounted prices. Having this predetermined plan prevents panic selling. Rebalancing is an often overlooked strategic element. Over time, your winners grow and become oversized portions of your portfolio, while losers shrink. At least annually, sell portions of oversized winners and redistribute to underweighted areas. This forces you to sell high and buy low in a disciplined way. Now, let me address a common question: should you stick to a strategy even when it's not working? Yes, with one important caveat. You should stick to your strategy through normal market cycles. Value investing underperforms growth for years at a time, then outperforms. That's normal. But if your strategy is fundamentally flawed, say you're using astrology to pick stocks, then please change it. How do you know if your strategy is sound? Backtest it. Look at historical data to see how your strategy would have performed over the past 20 to 30 years, including during major crashes. If it would have survived 2008 and 2020 and still produced positive returns, it's probably sound. If it would have been wiped out, revise it before risking real money. Another key point, write down your strategy. I have a physical document outlining my entire investment philosophy, criteria, and rules. When I'm tempted to deviate, I read it. This external accountability keeps me disciplined. Also, measure what matters. Don't just track your total return. Monitor whether you're actually following your strategy. Did you stick to your buy criteria? Did you avoid emotional selling? These process metrics matter more than short-term performance. Here's a harsh truth. Most investors would make more money with a mediocre strategy consistently applied than with a brilliant strategy inconsistently applied. Discipline beats brilliance. The investor who religiously invests 15% of every paycheck into an S&P 500 index fund for 30 years will likely outperform the genius who makes brilliant trades but can't maintain discipline. Finally, your strategy should evolve as you do. A 25-year-old with 40 years until retirement can tolerate more risk than a 60-year-old planning to retire in 5 years. Adjust your strategy as your circumstances change, but avoid changing it based on market conditions. The bottom line, having a strategy transforms you from a reactive trader buffeted by market emotions into a proactive investor with a clear plan. And following that strategy with discipline is what separates the winners from the losers. So there you have it, the 5 rules for successful stock investing. Rule 1. Do your homework. Research companies thoroughly, understand their business, competitive advantages, and valuations before investing. Rule 2. Diversify your portfolio. Spread your investments across sectors, company sizes, and geographies to manage risk. Rule 3. Control your emotions. Master fear and greed, avoid panic selling and FOMO buying, stick to your plan regardless of market noise. Rule 4. Think long-term. Time in the market beats timing the market. Let compound growth work its magic over years and decades. Rule 5. Have a strategy and stick to it. Define your investment approach, write it down, and follow it with discipline through all market conditions. These rules aren't sexy. They won't make you rich overnight. But consistently applied over years and decades, they will build substantial wealth while protecting you from catastrophic losses. Remember, investing is not about being the smartest person in the room. It's about being patient, disciplined, and rational when others are being impatient, impulsive, and emotional. If you found this valuable, please hit that like button and subscribe for more investing content. Drop a comment below telling me which of these 5 rules you struggle with most. I read every comment and often make videos addressing your questions. And most importantly, start applying these rules today. Don't wait for the perfect moment. The best time to start investing was 20 years ago. The second best time is now. Thanks for watching, and I'll see you in the next video. Happy investing!